Hi, this is Randy Finney with Right Side of the Chart, and this is a midday update for Thursday, June 20th, 2019. I want to do an update now midday. We're still in what I consider the wake of the FOMC meeting. I talk about, what I call FOMC noise, initial reactions from the meeting, not just the initial pop right at 2 p.m., but from my experience on the big meetings, and this one definitely qualifies as one of the big FOMC meetings, potentially market moving, with the market really looking forward to, what the Fed would do and what they would say at this meeting. That the FOMC noise, or that initial reaction, I've seen it carry for anywhere into the next day, into the following days, and because the announcement's always come on a Wednesday, sometimes it takes until the weekend. So, to that, again, I modified only one trade yesterday, the TVIX trade. I only changed that to make that stop from an intraday any intraday move below the stop price to a closing basis. QQQ I left alone because that trade was looking like it was going to be okay into the close. And I'm going to communicate if I make any changes as of now. Let's leave everything the way it is. Here, let's just look at that real quick. And if anything changes before the close, and I'm going to go over what might change, things I'll be looking for, then I'll communicate those thoughts. All right, where did it go? I've got a board here. Let me find the QQQ trade. Okay, here's what I'm talking about. The QQQ trade, since we entered that, the stop was and still and remains on a daily close above 188.30. How does that work, by the way? If you're new to the site, I've communicated this. What I do, if I have a stop that I'm using on a daily closing basis, what I'll do is watch that trade. If you're heading into the final minutes of the trading day, it's 3:50 p.m., 3:55, and you're well below that level. Then I'll just close it out then before the close. You can also close out QQQ in the after-hours session. And if it's close, that's up to you. Again, these are just suggested stops, but I do put a lot of thought into where those levels are. And because now we've carried into the that whole FOMC noise, we may today's rally. So far, we've faded about half the rally, but that's just a start. I mean, both the S&P and the Nasdaq are still up comfortably. As I'm doing the video right now, it's 11:40 a.m. Here, let me show you what we've done so far. Let's go to a 1-minute chart. QQQ was up. Here's yesterday's close. Futures lifted overnight. And I always say this, do not read too much into what the futures do overnight. Those are typically retail traders. Look, I'm a retail trader, but a lot of them don't know what they're doing. They're not the institutions. The institutions cannot maneuver. Liquidity has been drying up in the futures market. I shared an article that I forget where it was, Barron's or the Journal, really for years now. The liquidity has been drying up in the futures market, shrinking volumes. And I can tell you this, that the big institutions that are dealing with billions of dollars, they just can't navigate. It's not a liquid enough market. And so what you usually see is the minute the players step onto the field, you can see it. You would have seen a steady lift overnight, but then look, the second the market opened is about when everything peaked and we faded. So I want to just show you to kind of get an idea of what I'm watching today. So there was the pop. Futures lifted the Qs overnight to open up an impressive 1.4%. And as of now, they faded 0.82. So over half of that rally, half of those gains have been faded. As you can see, the minute the market opened, it was met with selling. These are institutions. And I'm going to just kind of go off on a tangent here. We'll cover the charts, but again, I want to reiterate what's going on fundamentally, because although I've been looking for a major top in the market and the economy for a while now, never at any point until now has the case been so strong fundamentally. And if you recall, you go back into late December when I was getting bullish, the market had gone down. I saw that downtrend coming, got out a little early, sat aside, said that, look, the risk reward isn't good, the market's ugly. But I laid out a scenario that a few things were going to happen in advance. I said, you're going to see everything change, because at that point in time, the dot plot had the Fed hiking rates. I said it's going to reverse. You're going to see everything. The Fed will back off and go dovish, and you're going to see that that we will get a rally. It'll be a sharp rally, and I said because the economy was not as far from falling off a cliff at that point. So in other words, I acknowledged that the sell-off, the correction that we had, it did, somewhat overshoot even my downside targets where I expected it to go, not by a whole lot, but it did oversee that. And I said it was too much too fast, that from largely, again, technically it was, the bounce was, the case was made there, oversold, some divergences, stuff like that. But fundamentally, and that's what happened. The economy at least back in December, everything was pretty darn good. There were a few things starting to roll over. Different story now. The Fed has acknowledged it. We're seeing economic indicators quickly rolling over. And right now, as I said before, and I've showed you a chart in the past, just recently in one of the videos, that historically, a Fed cut after a rate hiking cycle, the first cut precedes recessions. It always has. You go back in time, you can go back to the 60s and see that. So the old saying, or one of the economists said this recently, is that you want to go long the last rate cut and go short, or he said you don't want to go long the first cut, you want to go long the last. Now most economists aren't going to tell you to short, so you take that the other way. And what that says again is the Fed is now seeing, and they're now pricing in a high, I saw in the futures, there's a near 100% certainty in the Fed fund futures of 2 rate hikes going forward. And so once they start, that's the other thing. You don't just usually get a one and done. You start a rate cutting cycle. And again, just go back in history. You can pull those charts. I showed one the other day that the Fed has now gone to a downward, bias with the dot plot rates going down because they see the economy turning. And yes, there will be, and I promise you, there will be an agreement with the trade wars, and it'll be coming up probably soon. We have an election year coming up. China's been getting hit hard. Trump wants to mark it up as well. So you're going to have an agreement. It'll probably be a lot of fluff, not a lot of substance, but it'll be agreement, just like what we did with Mexico. They promise, oh, okay, we'll get a little tougher on the borders. Nothing concrete. Nothing's going to change there. So I just wanted to say that, and that'll probably be a pop when that comes. And that could come any day now. It could come weeks, months from now. We still have a while before the election. So I'm talking fundamentally, but one thing that it's not impossible, but it's very hard to turn the ship. Think of the economy like a tanker, a big super tanker out at sea. That thing doesn't turn on a dime, but when it starts turning, that's how the economy is. It just starts turning, it starts rolling over, and the ship has started to turn. It's actually been turning for a while, but now we're starting to see a more rapid deterioration. 6 months ago, there was one or two, you would see some cracks starting to emerge, but we're starting to see a acceleration or deceleration in the economy, acceleration of a rate of a lot of indicators going down. So that's fundamentally. Now here's the thing to that too. When I look at the chart, I should have pulled it up now again to go over it with you guys, but it's the one I covered the other day. They had the recession shaded. I think it was Trading Economics, if I remember right, that I got that one from, and it showed the Fed funds rates. But you could see that typically the first cut came, and it was pretty few months ahead of the actual recession. But also remember that recessions are declared in hindsight. By the time they come out and tell you the government acknowledges we're in a recession, it's usually we're well into it at that point. There's a lot of lagging indicators. There's a lot of lag time before those indicators are reported, like GDP, for example. And that's the measure of a recession. The one thing they look at, a definition of a recession or an economic contraction, are I believe it's two successive quarters of contracting GDP. And again, GDP is only reported quarterly. So you have January, February, March is a quarter. Then there's a lag time. They don't report it on March 31st. So you have to wait, and the GDP comes out almost a month later. So it's old news, up to almost 4 months old by the time it comes out. And then almost always they revise in hindsight. So 6 months, once you realize the stock market's down 30-40%, they start coming and saying, oh, we're going to revise Q1 GDP down. Our previous estimate was too high, or previous report, I should say. So that's how that stuff works. And I always say this, trying to trade off fundamentals, especially more active trading, swing trading, is akin to driving in the rearview mirror. If you wait for all those indicators to tell you we're in a recession, you would have missed the boat. Too late to get out of your longs. The market's down 30-40+% at that time, and too late to get into shorts. So just some food for thought there. So you kind of have to extrapolate the current trend. And again, I'm just all speaking of fundamentals now. Now let's get to technicals. So what do I want to see happen today to help, first of all, to see if we can avoid having those the two effective. We only have, I believe, two shorts right now in the market. The TVIX long, which is effectively, as I said, it's a sister trade to a short on QQQ. The market goes down, TVIX goes up. It's that simple. Not day to day. I know I always get the questions, why is the TVIX down today and the stocks are down? The trend, the big moves, not day to day gyrations. But what we'd want to see first and foremost would be a complete fade at today's gap. It may not happen today. It's possible. I'm not even going to put odds on it, but it's something I'll be watching for. So towards the end of the day this afternoon, if we go much lower and we're coming in to backfill that gap, that would be a big, big fade. That would be a big turn this candle red. Right now we have a green candle because we're still positive at this point in time. So if we get close, heading into the close, close to 188.30, I may suspend that stop. And I want to say this. All trade ideas, they're just suggestions. They're things I'm seeing, I'm doing, and I don't take every trade. I take most of those. But again, if I, for example, QQQ, I don't have any QQQ short positions. I have NQ short. I have SQQ and some IRAs, things like that. So, usually I'll take a trade. Sometimes I'll use a different proxy or something else. But I wanted to say that. So these are my thoughts where I think an objective level is for, ideal my price targets, objective stop levels, but that doesn't mean it's yours. If you're feeling pain, and I know some people are, then do what's right for you. Get out of a trade. The old saying is sell down to the point at which you can sleep at night. If you're short, it just means cover down to the point at which you can sleep at night. It's that simple. Okay, so moving on again, I'll if I make any revisions to that, I'll do so. And keep it, the trade is down 4%. So it's, again, as I've said before, this last QQQ short trade, we had shorter targets. It was based on the 60-minute chart, was going for the initial leg down to be followed by a kickback rally. And this one, again, whether it pans out or not, that's yet to be seen. It's certainly pushing the upper thresholds of where, I figured the bounce would go and where I'm going to allow, this trade to go. But again, it's only down 4% now, and was entered somewhere about right, what was it, 181, look at another monitor, 181.37. So, or somewhere in here, right there on that candle. And so, the final target, and if it gets anywhere close to that target, I will almost certainly be adding additional targets. So I want to say that. And that's about a 14% drop. But again, if it gets there, if we take out this level, if we reverse soon, I would be, it depends how we get there too, but if we get there in the fashion I think we will, again, I'll be looking a lot, probably double, if not triple that to the downside on targets. So I look at everything from a risk reward perspective, and that also, you factor that into your position size ahead of time. That's why we have the position size calculator on the site. Use it. On a trade with a smaller stop, you can take a bigger position and still have the same dollar loss. I mean, that's the important thing to everybody. People get tied up in percentages. There's a couple folks on the site that just continue to want to point out how much the TVIX trade is down, but that's percentage terms. Let's talk about that one. Again, TVIX, as I've said on numerous occasions, it's not a stock. It doesn't track a stock or a stock index. It doesn't track a commodity or bonds or a sector. It tracks the VIX, which is probably the most volatile of any index out there. And the VIX and TVIX regularly go up and down. All these rips and dips, it's had multiple dips. I replied to a question today, or a comment. Over the last year alone, it's had numerous rips and dips of 50 to 100% or more. There's a 230% run in just a few weeks. So there are fewer indexes out there that exist that are more volatile. Hence the 1/3 position size adjustment. You take the position size down. So the TVIX trade, as somebody was so kind to point out today, is down 17%. If you put all your money in TVIX, or even what you would normally put into something like Procter and Gamble or the SPY ETF, then that is financial. I won't call it financial suicide, but it's extreme. It's gross negligence with your risk management and position sizing. That's why I list the suggested beta adjusted position sizes. So if you take a 1/3 position and you have a trade down 17%, you're down just over 5, less than 6%, which is, for me at least, my swing trading style, normal, because on this trade, I'll have to look where we hit it, but we have, right now the final target, which it still has a very good chance of being hit if things can turn here soon and things play out as I expect. That's about 100% return. So cut it down. Yes, you're also cutting your profits by 1/3, but that's still a 33% return. And again, if that starts to play out, like I said, if the market scenario that I'm looking at plays out, this would most likely become an official target, and then you're talking much, much higher than 100%, maybe 150% or so. And then at the end of the day, if it's stopped out, it's just one of many trades. That's why I did the video yesterday on commodities, and I harped on what I like to do from time to time is the benefit of diversification and asset allocation. Diversification, have your money spread among different securities, but a diversified portfolio, you could have 30 stocks, but let's say they're all tech stocks or they're all just stocks as a whole. You're not diversified. That's 100% equity portion of your 100% of your portfolio. Asset allocation means trade commodities, for example. So we have Joe, an active trade on the site, already hit our first target, been actively updating that. Mentioned a couple pullback levels where we're objective buy points back to T1, didn't work, but again said this was even better support there, and we've broken out. So this one has a lot of upside. And again, the point is, this is what's moving. This is a stealth rally. They don't talk about these on CNBC and all those channels that much because they're boring, and most people, they're just not focused on commodities. But if you notice, they're doing a whole lot better than the market recently. And again, that shouldn't be all of your portfolio, but certainly I think a piece of the pie. So there's wheat, corn, which I said is mostly a sister trade to wheat because they tend to move in lockstep, at least recently they have, especially sugar. Again, these are just ETNs, and you can see for the last, what is that, just 3 weeks, it's up about 10%, 11, 12%. Soybeans, and again, they were all covered extensively in a video yesterday. Looking good. A lot of momentum there, and I think we'll continue to see more upside in a lot of these, as I showed you in that video there. So just a piece of the pie. Again, then there's gold. Gold's now, I'll have to do a separate update because gold warrants a separate update. It's hit this long-term target I've had for over a year, 130, very big level. We could go on through there. Somebody asked my thoughts today, and again, I'll do this in another update. Basically, I want to tell you this now. I think the risk reward right now is not very favorable to add to, especially to take a new position. I have no desire at this point to short gold either. And where it goes from here, I can tell you, if the markets do reverse soon, whether it's today, tomorrow, or next week, and we start another leg down, if this proves to be just a marginal new high on the S&P 500 that fails like the previous two did with big corrections that followed, then gold can power right on up through here to my next target there, about 151, we'll call it 150 or so. If the market breaks out to new highs and keeps going, and there's another 5-10% upside, which I don't believe is going to be the case, but it's certainly possible, then gold could correct. You'd probably see that flight to safety bid come out of gold. But again, right now, favor maybe some consolidation here, but it depends largely on what the market does. But again, I'm liking everything I've seen recently. Euro-US dollar pair has broken out of that bullish falling wedge. This is the weekly chart. You can see it there. Tracked this for many, many months. We finally got the breakout. We're bouncing against some resistance, but it's looking pretty good. As I mentioned the other day, we back tested again. Boom, we moved up. So I want to make very clear, I remain longer term bullish on gold. Intermediate term or short near term, let's say neutral to slightly bearish, but again, I'm sticking with core positions. I'm not going to get shaken out of that. I'll micromanage. I may take some off today or tomorrow, depending on what the market does. But as of now, and that's why I wanted to do this video, I wanted to let you guys know that despite what might seem like a uber impressive rally, it doesn't change the technicals. So we go back here. This is the SPY 60-minute chart, and if you've followed this analysis for the last few months, we had this top here, and what's in common here? We had clean negative divergence at the highs. There's your divergence lines. There's the divergent high, followed by a biggest correction that we've had so far in 2018. That ended, yes, same stuff I keep talking about. Divergent low, nice trend line to trigger the buy signal, positive bullish divergence. And so right now, what should make this any different? We don't have a sell signal yet, but we have divergence. And as I said in yesterday's video, this is not a trend line up top. It's only a divergence line. It only catches 2 points, not multiple points. This is your trend right here, your uptrend in prices with multiple reactions there. So here's that wedge I'm watching, and if that breaks, especially impulsively, a couple things will happen. If it does happen soon, that is, we'll get a failed breakout in SPY. That's pretty bearish if we can't hold the breakout and build on those gains, and we'll also get a sell signal there. So that's what SPY looks like. Here's what QQQ looks like. QQQ has yet to take out the previous highs. You can see right here. There's your highs back from April, and we're still comfortably below there from now, but we're in an uptrend, so there's no mistaking that. I might talk about these divergences and these wedges, and I've seen wedges and divergences get burned through, but as of now they're still intact, and we need to watch for that. And again, first things first. First things would be a fade of today's rally. That would a complete fade would be pretty darn bearish. That'd be a big red reversal stick. Try to imagine what that would look like if they faded again 100% of these gains, which was about what I say, a 1.4 pop. It hasn't happened yet. It may not happen, and if it does happen, it may take until tomorrow as well. If it happened today, that'd be pretty nasty. And again, if it does, then the next thing you want to watch for are the trend lines, and then the other levels that I mentioned recently. All right, so let's go on to futures. ES, there it is on the ES. Sometimes you just have nice, clean-looking charts on the futures, which trade virtually around the clock. And you can see there it is. We had a small little divergent high there, pointed that out, and we did get a correction from it. And then we kind of went into that holding period because right in front of the Fed, and then this is all, there was a Trump Draghi tweet, there was a Fed announcement right there, and then what we've had since. But we're just working our way up within this wedge, and so I'm watching obviously this trend line here. And again, I see no reason why that wedge, if it does break, won't play out comparable to the way this wedge broke out right here. Same thing, bearish rising wedge, breakdown, back test, and then boom, correction. Just like the bullish falling wedge there. NQ, that was ES, this is NQ. So here's our uptrend line. There's our divergence right there. So that's where we're waiting for. We have some support there. I probably should add that line. I need to add a few more levels here to this NQ chart. By the way, it's the same chart I posted this morning. We'll lower that a little bit. Let's lower that line to come in and catch. Here's what I'm doing on this. I'm catching these reactions right here. You can see reactions from above, multiple reactions. Once that support level was broken, it's about 7,700. We broke down below, and support once broken then becomes resistance. So you could see we failed multiple times at that resistance level, failed again here, pulled back, and finally broke out the other day. So as of now, it's a breakout. So what happens if we drop down below that 76.95 level or so? Two things will happen. We'll have broken support, which gives us a failed breakout, aka bull trap, and we will also have broken the trend line, which gives us a sell signal on the bearish rising wedge. And so these are the things I'm looking for. Bulls want to just keep buying the pullbacks of the trend line. If you think the market has another 5, 10%, 20, whatever it is upside, here's an uptrend. You can buy that uptrend, and if the market's strong and the buyers are going to come in, which they could, then it will likely burn through these divergences and might not play out. Or maybe you get a little false breakdown and a little bear trap and we run up. So you can trade these charts as you see fit. I'm just showing you the levels that I think are key levels, and how the market might react if and when those levels are tested or they break. Oh, I haven't covered the smallies in a while. Small caps. This is IWM, the small cap ETF. You can see all the other lines, and like everything else, we had divergence on all the indexes back here at the lows recently. bullish divergence. And likewise now you can see the negative divergence forming here on IWM. So there's our divergence line right there, comparable to those I showed you on the SPY and QQQ, as well as the futures. And there's the uptrend line to watch. So they all come in roughly together. So that's what you want to see. And again, you put a higher weighting on SPY and QQQ than you do IWM because the large caps make up the bulk of the stock market and are much more significant. But ideal if you can see all of those break these trend lines. And otherwise, IWM, like a lot of indexes, still well below the lows. Right now, it's just the S&P 500 that's popped the previous high, and the day is young. Let's see if it holds it, or can we continue to fade this rally, and then have yet another false breakout, which I mentioned before. We look at SPY, the S&P 500. Now let's go to a daily chart here. Let's turn off our annotations and show you. As I did today, I think I put up a post here. So there was a high there, a major reaction high that was an all-time high on SPY, followed by a big correction. So then from there, we worked our way up. I'll just draw a straight line over, and we broke out. And typically breakouts to new highs are supposed to be bullish because all traders at that point in time are profitable. Nobody's underwater. At a 52-week or all-time low, everybody's in the stock or a sector or index is underwater, and so that's bearish. They want out. They want to get the first bounce. A lot of them, not everybody, but a lot of them want to get that first kickback rally, and the opposite happens. However, as I say, so while new highs, breakouts to new highs are considered a bullish technical event, I don't take them because they're prone to fail when you have both overbought readings and negative divergence as we did at that time. And so, as I often say, fewer things in investing and trading are more bearish than a failed breakout. So you had a breakout to new highs. Once the breakout failed, the market didn't hesitate. The minute the breakout failed, that's this red stick, it dropped hard and never looked back. Had 3 kickback rallies and then went down. So what have we done now? Let's just take a line from that high right there to that other high. We made a slightly marginal new high. The S&P couldn't hold those gains, failed. Another bull trap or false breakout, and then again the biggest correction that we've had all year. And what have we done? Once more. So that's the pattern right now. Doesn't mean it's going to always be the pattern. That's one thing you learn in trading. Sometimes as soon as you recognize a pattern, right around when you recognize it, that's when it stops working. But as of now, that's been the MO. Breakout, fake out. Breakout, fake out. So we'll see if this one sticks or not. Obviously, you guys know what I'm thinking, which way I'm leaning, and even if it goes and I start scaling out of my shorts soon or tomorrow, later this week, I can promise you it's not a new high I'm going to chase. Not, at least not with index shorts. There's always things out there to make money, and I'm making a point. I want to get some more ideas out to you, and even if they're going to be official trade ideas, I'm going to start passing more of those along. We still have what is a couple longs. What is one of them? KHC. Kraft Heinz, getting up to the first target now, things like that that are lower risk because they're not at all-time highs, they're not overvalued. KHC obviously has its problems, but I believe a lot, if not all of that's been priced into the stock already. So at least I think you have less downside, but there's still some issues there. So I don't mean to come across as there's no risk at all in this stock. I mean, they've had some accounting issues, and they say there can be more, but the fact that they're saying that now tells me that it's probably priced in, and if they come out with another revision, then the market might be sell the or buy the rumor, or sell in reverse, buy the rumor, sell the news. They could even pop on that. But again, that's just one trade. Like everything, going back to what I said in the beginning of the video, it's all about diversification. Everybody's different, but typically you shouldn't have any one individual stock position or trade that makes up more than 10% of your portfolio. Some people will do a lot less, 2, 3, 4, 5%. It's just how much can you manage. And again, are you doing ETFs? Because there's a difference of having one single stock as 10% of your portfolio, or the S&P 500, which is an index fund of 500 different companies. And by that I mean the S&P 500 isn't going to gap down 26%, 27%, or whatever it was in one day from accounting irregularities. That's the difference of trading an index which is diversified, even though it's one security, versus trading an individual stock. Okay, guys, let's wrap it up here. They continue to fade away. I'll wrap it up with the SPY 1-minute chart. SPY gapped up about 1% today and has so far, from the highs there, dropped. I'm not grabbing the exact top. You gotta get that right on that top candle, somewhere around there. It's dropped about 0.63%. So we faded more than half the gain so far on SPY, and again, these are things I'm looking for, and this is why I may, and it's rare that I'll revise a trade more than once, but this is again post FOMC noise, and if I see enough bearish action and evidence in the charts today that say, you know what, maybe give it another day. If the QQQ trade or TVIX trade are getting close to those stops, I may temporarily revise or suspend them. But again, that's up to you, because you run the risk of digging deeper in a hole. If tomorrow's, let's just say today's a pullback, a little profit take, and then we gap up again tomorrow. So you have to take that into consideration, and use your own stops, whatever. If take trades first and foremost that you're comfortable with, align with your analysis, and then use stops and profit targets and position sizes that are in line with your own trading style, risk tolerance, etc. All right, we'll wrap it up here, and I'll do a follow-up post or video before the close again if I make any revisions to any of these trade ideas. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.